the
Aishak, thank you for the invitation and for organizing this important conference. I hope that the sound is clear on your end in the conference room.
Excellent.
Excellent, thank you. So without any further ado, I'd like to start this presentation with the broader theme. The question that I'm pondering here is, can Africa mitigate its climate risks in the carbon bubble and the stranded assets that are piling up on the African continent as we speak? And I'll define these terms as we move forward. And it's so pertinent that we're having this conference and this conversation as COP27 is being finalized as we speak in the next couple of days, hopefully with some important commitments to decarbonizing, some important commitments to the loss and damage fund, hopefully. I'd like to start by briefly listing some of the climate impacts that we're dealing with on the African continent in particular, and most of you are familiar with these. We're talking about floods and droughts, obviously in different regions of the continent. With climate change intensifying, the droughts are becoming more intense, but also floods are becoming much more of a risk in floods that happen off season in different seasons. Heat waves are going to intensify, even though the world is on track possibly right now to keep global warming below the 2-degree limit by the end of the century. The African continent actually will reach and probably exceed the 2-degree limit by the last 2 decades of this century, so by 2080, according to the IPCC. So overall global warming, we're aiming for 2 degrees, but on the African continent, the warming will be higher than 2 degrees, unfortunately, in some parts of the continent. Water scarcity is becoming increasingly an issue and will intensify. Sea level rise, coastal degradation, and erosion, food security risks are already happening as we speak and will probably intensify with declining crop yields because of heat waves, because of droughts, and so on. Health risks, especially mosquitoes carrying diseases such as malaria epidemics. It's expected that these things will intensify, especially with areas that experience heavy rains and heat. And then, of course, on the economic front, negative impacts on GDP. And I'll show you some numbers from the IMF in the next slide. And an important and significant problem that is already happening and will intensify is the problem of climate migrants or climate refugees on the African continent. And I'll show you some numbers from the World Bank in the next few slides. So on the economic front, this is an estimate that the IMF produced a couple of years ago with other development agencies, looking specifically at the African continent in different regions. So in our region in North Africa, a 1 degree warming will have a slightly negative impact on GDP. But if we move to the 2 and 3 degree global warming, overall GDP decline can be as high as 2.7%. But the region that will be affected the most at the 2 degree global warming by the end of the century will be West Africa in particular, almost 10% decline in GDP. So all of these numbers are not good, which means that we must double and triple our efforts to decarbonize and mitigate the risks that are already building up on the African continent. On a global scale, and this is why it's so important to focus on fossil fuels. This graph is from the UN Environmental Program production gap, the production gap report, which was published in 2021. Essentially, what this report is looking at is how much are we planning as a globe, how much are we planning to extract and burn by 2030 and 2040? Notice they're not even looking at 2050 anymore, versus how much we're allowed to extract and burn. And as you can see, by 2030, we're on track to produce and burn twice as much as we're allowed if we're going to meet the climate challenge. And by 2040, we're on track to produce and burn almost 4 times as much, which means the science is very clear. We must phase out fossil fuels immediately. So as an immediate step, we need to stop the construction of additional fossil fuel infrastructure and then start rapidly phasing out existing fossil fuel infrastructure, especially starting with coal, but that also includes oil and natural gas. And unfortunately, with the Ukraine crisis, we're seeing the exact opposite. We're seeing the African continent, with investments from Europe in particular, bringing hundreds of billions of dollars, up to $400 billion estimated, worth of investment in natural gas alone in countries like Senegal, Nigeria, and across the continent, to be honest. So we're not moving in the right direction. On a global scale, the largest oil and gas companies are investing in terms of capital expenditure up to $1 trillion per year, and planning to invest up to $1 trillion per year of new infrastructure globally, not just on the African continent. So instead of phasing out fossil fuels, we're seeing fossil fuel companies actually increasing their production capacity, and as a result, increasing the emissions that will come out of these fossil fuels. And that's a huge economic risk that represents potential losses for investors and for countries who commit to this infrastructure. And that's what I will describe in a minute as the carbon bubble and the stranded assets related to fossil fuels. So stranded assets. As I said, Africa expects about $400 billion of new investments in natural gas in particular, possibly more. Examples of stranded assets. So what are stranded assets? With the impact of climate change, when you have coastal properties, hotels, resorts flooded because of storms and because of sea level rises, as an investor, when I invest in a company that manages hotels or owns hotels and resorts, I expect a certain rate of return over the next several years, several decades. But when that property is flooded, the expected rate of return drops to 0, which means that particular asset becomes what we call a stranded asset, which means it doesn't generate any revenues, and I can't sell it because nobody's going to buy a flooded hotel. Same thing with oil and gas infrastructure. When the world wakes up to the reality of actually needing to rapidly phase out fossil fuels, maybe in 10 years, I'm estimating, it means that in 10 years, we will actually shut down production of fossil fuels, maybe starting with coal, then moving to oil and gas, which means the investors that have put their money in a project that is expected to generate revenues for the next 30, 40 years worth of extraction of fossil fuels. But now, because of our commitment to decarbonizing, and because most countries will move away from fossil fuels, those oil and gas resources and infrastructure will become stranded assets that you can't sell and you can't generate any revenues from. So the size of these stranded assets is estimated in the multiple trillions of dollars, depending on the studies. Some people estimate the size of this carbon bubble up to $30 trillion. Some studies put it up to $100 trillion globally. But we know that the numbers are massive, not just in terms of oil and gas, but as I mentioned, coastal real estate, especially for countries that depend heavily on tourism. There's potential losses related to loss of tourism revenues from coastal properties, fossil fuel infrastructure, but also agricultural equipment. Think of a very simple example. If I'm a small farmer today and I spend $100,000 to buy tractors and equipment for farming, and then I expect that for say up to 30 years, but in 10 years we ban the consumption of diesel globally because we realize that's an important problem for climate change. Then what do I do with that tractor? That tractor becomes a stranded asset. And when the tractor becomes a stranded asset, the companies that produce the spare parts, the repair parts for that tractor will also cease to produce those components. So you have across the world hundreds of billions of dollars worth of stranded assets because we haven't done the right decarbonization work to have a smooth transition away from fossil fuels. Transportation infrastructure, same thing, hundreds of billions of dollars worth of stranded assets potentially. So how do we deflate this carbon bubble? So most of you are familiar with the regular stock market bubble or financial markets bubble, is when you have the size of the market or the price of those assets be overvalued, and then people recognize the real value of those assets, and you have the bubble essentially popping or deflating and going back to the real value. In our case, we have financial institutions, pension funds, retirement funds all over the world that are heavily invested in the carbon economy, and as a result, they have a massive climate risk embedded in their balance sheets, and that's the hard work that needs to be done on the financial side, is how do we decarbonize these balance sheets and these portfolios. And this is where the role of central banks and regulatory agencies is important. On a global level, there's an organization called NGFS, the Network for Greening the Financial System. And the Central Bank of Tunisia is a member of this network. The European Central Bank finally joined 2 years ago. The Federal Reserve Bank finally joined 2 years ago. So it's a network that invites central banks and financial regulators around the world, including insurance regulators, to think about strategies and implement strategies to decarbonize the financial system and eliminate these climate risks. And I'll give you just one potential proposal that I'm hoping will make it through policy, and maybe we'll hear about it soon from the Fed, from the ECB, and other central banks around the world. Central banks regulate the capital adequacy ratio that banks are expected to have. The problem is that this capital adequacy ratio now doesn't recognize the climate risks. So one of the proposals that we're seeing floating around the green space, so to speak, is to transition to two types of capital adequacy requirements. One that is the traditional one, the carbon-based one, and then to create a new one, a lower capital adequacy requirement for green capital. And this immediately incentivizes banks to lend and invest more in green investments, because they will be profitable, because they will have a lower capital adequacy requirement, and that will unleash hundreds of billions of dollars worth of investment in the green economy to help accelerate the transition. So these are things that central banks can do immediately, and I'm hoping that this will happen in the next couple of years, and that's the best way to leverage the firepower of the financial industry to accelerate this transition. As you see from this map, this is a global map of water stress. The African continent and the Middle East region in particular is a very at risk already, and those risks will accelerate over time. And as a result, the economic consequences are serious. And now I come to this study that the World Bank produced called Groundswell. And this is from the 2021 report looking at climate migration or climate refugees. And as you notice, sub-Saharan Africa is the largest region that will experience the largest amount of climate migration. North Africa, 19 million people, sub-Saharan Africa, 86 million people by 2050. But this study also looks at 2030 estimates. So 2050 is not very far, but 2030 is the day after tomorrow. So let's look at a little bit of the specifics here. They run 3 scenarios in this study, and the most pessimistic scenario is the scenario that produces the highest numbers, obviously almost 200 million people. So here's the regional distribution of this study based on the 3 different scenarios. As I mentioned, Africa is the most impacted continent and region of the world. Zooming in on North Africa, our region in particular, this is the 2030 estimate of in-migration and out-migration. So the blue colored dots are the areas where we're going to see out-migration, and then the reddish or burgundy color are the regions where we see in-migration. And notice the clusters in North Africa, in Egypt, and Tunisia in particular. So these are 2030 estimates. Is 2050. Notice things get darker and more intense. But this is already in motion, and most of us already know that people are already moving because of climate impacts. Because when people lose their livelihood, and loss of economic opportunity forces economic migration, but it's really triggered by climate impacts, and this will intensify in the next couple of decades. On a global scale, and also on the African continent, we have another serious problem, which is global income distribution. But it also maps almost perfectly with the distribution or the inequality of CO2 emissions. The richest 49% emit, the richest 10% emit almost half of the global CO2 emissions. The African continent as a whole today emits the equivalent of what Spain alone emits in Europe. As Dr. Amani earlier said, the African continent is responsible for less than 4% of global emissions. And historical emissions have been the responsibility of the global north. The other structural problem that we must take into account, if we're really trying to think about how do we decarbonize, how do we mitigate these risks, we have to recognize that the international economic and financial architecture is extractive from the African continent in particular, but also from the global south in general. So let me kind of quickly interpret this picture for you, which I call neocolonial net wealth extraction. If you net out all global financial transactions between global north and global south, and including foreign direct investment, exports, imports, interest payments, debt cancellation, everything, the net amount, and if you focus on the green line here, the last year where this study was done is 2012, I believe. This gives us $2 trillion moving from the poorest countries in the global south to the richest countries in the global north. So the net flow of financial resources is moving in the wrong direction, and it's not new. If you notice, the green line has been accelerating in that direction. And if we don't do anything about the global financial architecture, in 5 years, this number will be larger. In 10 years, it will be larger. So if we're serious about climate change and decarbonizing, we can't have a climate policy without an alternative economic development policy and an alternative design of the global financial architecture, because the finance is not going to work out with the existing architecture. So the question becomes, are countries prepared to accommodate mass climate migration, to decarbonize, to do all the massive transformation that is needed? Do we have the fiscal capacity to pay for it without causing inflation and without bankrupting nations? And that's really where I go into my niche here in the economics profession, which is how do we pay for large transformative public policies, economic development policies, without triggering inflation and without triggering currency depreciation or without bankrupting countries, essentially. So here's how I think of this framework. So what I refer to here as the spectrum of monetary sovereignty, it basically means that not all countries have the same degree of monetary sovereignty. Some countries have a high degree of monetary sovereignty, like the US, Japan, Canada, and so on. And some countries have no monetary sovereignty whatsoever. In other words, you have countries that don't even issue their own currency, like Ecuador, a country that dollarized, uses a foreign currency. But most of the African continent, which is what we're talking about today, would be in this area with limited degree of monetary sovereignty. And what limits the degree of monetary sovereignty is two things. One is the level of external debt that the country has. And I emphasize external debt, meaning debt denominated in foreign currencies, in dollars and euros and British pounds, not to be confused with national debt in the national currency, because that can be managed differently and with fewer risks. So that's point number one. The more external debt you have, the weaker your degree of monetary sovereignty will be. And number two, which is related to it, the more external debt you have, the more desperate the country becomes to fixing its exchange rate artificially at a higher level in order to insulate itself from the risk of imported inflation, which I'll come to in a minute. So my research focus then becomes, how do we take a country from the limited degree of monetary sovereignty end of the spectrum and design strategic policies that allow it to, over time, increase the degree of monetary sovereignty? Because the larger the degree of monetary sovereignty, the more fiscal spending capacity the country will generate. And that's what we need. We need to generate massive spending capacity that allows countries to decarbonize and transition their economies without causing inflation and without currency depreciation and so on. So that's the exercise. How do we move from this end of the spectrum to the higher end of the spectrum? And this is not, monetary sovereignty is not something that you declare with the presidential decree. It's something that you acquire with strategic investments, with hard work. So most people in the economics profession will tell you, when you think how much can we as a country spend safely without causing inflation, say, well, government has the capacity to collect taxes, maybe to borrow from private markets up to a certain limit based on market discipline. But what I'm suggesting here is that there's this additional spending capacity, this bright yellow space. That's not infinite, of course. It's limited and it's constrained by the risk of inflation, this red bar here. That's the limit. And the question becomes, what determines the risk of inflation? Like, how far can a government go with deficits, with this additional spending capacity, before triggering inflation and all the consequences? So for me, the risk of inflation comes from two sources. One is the lack of productive capacity. That includes logistics, supply chains, disruptions, and so on. In other words, if you run out of productive capacity and the government continues to spend, of course, you're going to trigger inflation pressure points across the economy, not across the entire system, but there will be specific inflation pressure points. It could be food, it could be energy, it could be housing, it could be transportation. So it's very important to identify where those inflation pressure points. So the solution to these inflation pressure points from a productive capacity perspective is not austerity. It's the opposite. The solution is actually to invest strategically to build additional productive capacity. And if you do that successfully, you actually push the risk of inflation further out and you increase the size of your additional spending capacity. And the good news is that you create jobs in the process. So what I'm suggesting here, one way to fight the risk of inflation is actually to strategically invest in these key areas where you have lack of productive capacity. And most of the African continent, and Tunisia in particular, here we're talking about key inflation pressure points related to food, imports related to energy imports in particular. And then the second problem that generates inflation risk is what I call abusive market power and price setting behavior. In other words, if you have key players who can raise prices simply because they can, because they have a high degree of market concentration, because they're not regulated, because the government is not paying attention to the abuse of market power, then of course that kind of inflation risk, again, is not going to be eliminated with austerity policies. It can only be eliminated by making the market more competitive. In other words, taxing and regulating this abusive market power out of existence. So if we do 1 and 2 simultaneously, and that's a big if, because this is not easier said than done. If we do that successfully, then we're effectively successful at increasing the size of that additional spending capacity, and we're pushing the risk of inflation further and further out. So that's the exercise that every country on the planet must undertake in order to create the fiscal space for these transformative investments that need to take place on a global scale, and especially on the African continent. So that's the paradigm shift that I'm suggesting here. So a quick recap of the structural weaknesses that we deal with on the African continent and the global south in general, and most of you will be familiar with these. We have structural trade deficits that produce high levels of external debt. And to me, the root causes are 3 basic areas. Number 1, we have energy deficits, and this is true even for the biggest fossil fuel exporters on the continent, like Nigeria. Nigeria doesn't refine any of its gasoline. Nigeria exports crude oil and imports gasoline. Notice, imports higher value added material and export the raw material, low value added content. Africa as a continent today imports 85% of its food. Tunisia, those of you looking at the food inflation that we're dealing with in Tunisia, you're very familiar with this problem, how much we import from Russia and the Ukraine and beyond. And then the third deficiency is the low value added industrialization that most countries on the African continent specialized in. In other words, we import capital, we import the energy, we import the intermediate components, and we use low cost labor for assembly line manufacturing. So you import high value added content, you export low value added content. It's a trap that becomes very hard to get out of. So the structural effect of these trade deficits is a downward pressure on the value of the currency. Say in the case of Tunisia, the dinar starts to lose value relative to the dollar, to the euro. And with a weaker dinar, everything we import, whether it's food or fuel or medicine, becomes more expensive with a weaker currency. So we import inflation, food inflation, fuel inflation, medical equipment inflation, everything else. And that creates a dilemma for the government, because the immediate reaction is to deal with the inflationary pressure by subsidizing food, subsidizing fuel up to a certain point, of course. And simultaneously, what the central bank will do typically in any country that experiences this is to borrow dollars and euros and British pounds and Japanese yen in order to artificially strengthen the exchange rate. But what I'm suggesting here is that these are band-aid solutions that don't lead to any transformation in the long term. What we need is 3 strategic investments, long-term investments. 1 focused on food sovereignty. Number 2, focused on renewable energy sovereignty. And number 3, industrial policies that move us to a higher level of value-added manufacturing over time. Easier said than done, but we have to start somewhere, and it's easier done on a regional level rather than a national level, especially for small countries like Tunisia, where you can't generate the economies of scale in a country with 11 or 12 million consumers. So the important thing to recognize here is that the mainstream economic development model that is often dictated by the IMF as part of the conditionalities, and that is dominant in the economics profession in general, it's very important to recognize that these are false solutions that are actually anti-development. They're not pro-development. And anti-development, I should say anti-climate also. Austerity policies, debt restructuring, privatizing state-owned enterprises doesn't really solve any of the structural problems. It's just brings in a little bit of cash, and once you spend it, you're back to square one. Labor market flexibility, meaning pressure on labor unions, doesn't really solve the structural problems we discussed. Foreign direct investment and export-led growth. Unfortunately, these are part of the traps, because when you're talking about low value-added manufacturing, so exporting more implies importing even more energy, more capital, and more intermediate components. But when it's foreign direct investment, the profits are also repatriated. So we have the negative terms of trade actually accelerating with more FDI, unless you have an industrial policy that capitalizes on higher value-added content of manufacturing, an industrial policy that builds the forward and backward linkages that you actually need for a successful industrial policy. And that is, unfortunately, hasn't been the case on the African continent yet. Financial liberalization, very risky, leads to speculative bubbles that we've seen in South Africa, we've seen in Turkey, we've seen in Mexico and Brazil and other places. You can't create artificially vibrant financial markets when you have an underlying weak economy, because you end up attracting speculators and you lead to a stock market bubble, followed by a crash, followed by a currency crisis. That's not a solution. Tourism, and I said this many times in the Tunisian context, but it's relevant across the global South. When you don't have food sovereignty, when you don't have energy sovereignty, tourism appears to be a solution, because you create lots of jobs in hotels and restaurants and so on. But the millions of tourists that you bring, you have to feed them, you have to transport them, you have to heat and cool the hotels, you have to entertain them. So you end up importing more food that you don't have, more energy that you don't have, and more capital for hotels and entertainment centers and so on. So you end up losing just as much, if not more, foreign currency reserves from the tourism industry when you don't have the foundation of a sustainable economy, especially food and energy. So it can be a drain on an economy, not just in terms of resources sustainability, but financially. Remittances, unfortunately, this is not a development policy. Tunisia right now, the biggest contributor to foreign currency reserves at the central bank are Tunisian workers abroad, remittances, and that's not a development strategy for a country. It's a huge brain drain, and it's unsustainable. So we end up with a race to the bottom with more external debt, and we're told there is no alternative. And what I'm suggesting, these are the structural traps that we need to avoid with strategic investments in food sovereignty, energy sovereignty, and industrial policy. And I'll illustrate quickly what I mean by the value-added content deficiency that we have. And here I picked Nigeria. You can look up the Atlas of Economic Complexity. They have all the countries, including Tunisia, if you're interested. Look at the composition of Nigeria's exports in 2020. Look at the composition of Nigeria's imports. You can just eyeball the high dependence on raw material exports and the high dependence on high value-added content and food content in terms of imports. This is typical across the African continent, across the global South. This picture has to change. If you compare Nigeria, if you go on the Atlas website, compare it to, say, to Japan's composition of exports and imports, you'll see the difference immediately. So To summarize what we have here, the Global South suffers from low degree of monetary sovereignty. The Global South is not responsible for climate change, has high external debt, low productive capacity, low research and development capacity, and suffers from what I call this neocolonial extractive economic system. On the other hand, the Global North has high degree of monetary sovereignty, meaning a much larger fiscal spending capacity, is responsible for climate change, what we call a climate debt, has low to no external debt, has high productive capacity, high capacity for research and development, and benefits from this neocolonial extractive economic system. And as a result, to help the African continent transition to a higher degree of monetary sovereignty, what is unavoidable here is a system of reparations, which is what people at the COP27 are referring to as the loss and damage fund, whereby the Global North will compensate the Global South for climate damage. But when we talk about reparations, it's not just monetary compensation, it's also transfer of technology, transfer of know-how, strategic partnerships to build productive capacity in the Global South and allow the African continent to leapfrog away from fossil fuels and into a greener, more sustainable economy. That has to be part of a global conversation. It's apparently not going to happen at COP27. Hopefully COP28 will be the historic moment where we finally put the money and the resources where they need to go to accelerate this transition. And finally, I'll close with the importance of industrial strategies and why it's important on the African continent in particular to have a Pan-African industrial policy, industrial strategy via South-South strategic partnerships. Number one, with an industrial policy on a continental or regional level, you have access to larger markets, which allows you to reach the economies of scale needed to industrialize. You can't reduce your cost per unit when you have a small market internally. And if you aim for exports, good luck competing with made in Japan, made in Germany, made in the Global North. So we have to focus on building capacity internally. You focus on complementarity of resources and capabilities, especially natural resources on the continent. And you build these horizontal linkages to increase the value-added content, on the continent.
Fadhel?
Yes.
Excuse me to interrupt you.
Yeah.
We don't have too much time left.
Okay. Yeah.
Okay.
I'll wrap up after the slide. Thank you.
Thank you. Thank you.
Yeah. So it's very important to build these horizontal linkages to increase the value-added content, focus on collective resilience by prioritizing investments in food sovereignty, renewable energy sovereignty, water security, education, health, transportation. And this is how a country acquires a high degree of economic and monetary sovereignty over time. And on a continental level, if a country or a region lacks this basic level of resilience, it has no bargaining chips in international trade or in any other negotiations. You can't walk away from a negotiation table, and it will continue to lose economic and monetary sovereignty over time. So this strategic Pan-African industrial policy must start with renewable energy manufacturing. Why? Because we have large internal demand to reach economies of scale. 600 million Africans today lack access to electricity. All raw materials are available on the continent to manufacture solar panels and wind turbines. The technological partnerships must come from outside the continent, unfortunately, either from Germany or the US or China, but these partnerships have to happen on African terms, not on extractive neocolonial terms. And as the Barbados Prime Minister often says, we in the Global South, we're friends of all, satellites of none. In other words, build joint partnerships, research and development, transfer of technology, loss and damage, climate reparations, but without a hierarchical colonial control from the Global North to control African resources. And the energy sector is so critical to tackle other structural issues related to poverty, health, sanitation, food, water, transportation, and so on. You can't have a functioning economy without access to energy. So hitting two birds with one stone, meaning developing a Pan-African industrial policy that prioritizes energy production, renewable energy production, will be the first stepping stone to prosperity and sustainability and decarbonizing the system and eliminating the potential for all the stranded assets and all the carbon bubble effect that I described in the beginning, and mitigating the impact of mass climate migration and all the climate risks that we discussed in the beginning of this presentation. I have a couple of other slides that I will skip, but maybe will come up in the Q&A portion of the discussion. So I'll just skip to the concluding remarks. We have 10 years to go. The climate crisis and all the other crises require urgent and bold action. The current jobs policies, climate policies on the African continent are too weak, too slow, too expensive, ineffective, and obviously dangerous. The continent is accumulating a substantial amount of stranded assets and is fueling a substantial carbon bubble that we must address. And therefore, preparing countries for mass climate migration and all the negative effects we discussed requires a fundamental restructuring of the global economic architecture. And as I sometimes refer to it as a global Green New Deal with climate and colonial reparations is possible, desirable, and affordable. Thank you.
Thank you so much, Fadhel, for this very insightful presentation, very exhaustive also. You spoke virtually about everything, every aspect, starting from the climate risks until all the economic solutions and also obstacles to achieve this green transition. You presented very clear graphs and insightful statistics. We like numbers, you know. And I think you helped us connect the dots. Can we start a Q&A session?
Yes, I'm happy to answer any questions. Feel free to ask in French, Arabic, or English.
Très bien. Est-ce qu'il y a des questions dans la salle? On peut poser les questions en arabe, en français, en anglais. On n'est pas plus gâté que ça. On n'est jamais plus gâté que ça.
I lost my German a long time ago.
Sorry?
I lost my German a long time ago.
we have here a German invité, guest, a German guest. Yes. Est-ce qu'il y a des questions dans la salle? Ah, Silémine, Fadhel. Alors, Professor Fadhel, we have here Monsieur Lemine Hamas. Il est le doyen honoraire de la Faculté des Sciences Économiques et de Gestion de Sousse. Il a une question à vous poser.
Merhaba.
Silémine, le micro.
Félicitations pour la conférence. Elle est vraiment très intéressante et d'actualité. Mais les conséquences des changements climatiques sur les économies, notamment africaines, en termes de déstructuration, étant donné que la majorité des pays africains ont une structure dominée par l'économie rurale, les changements climatiques affectent certainement plus durement le monde rural que le monde urbain, n'est-ce pas? Ce qui conduit à ce que vous avez bien décrit, à une migration climatique très importante et le surbooking des villes et la déstructuration conséquente du monde urbain. Et donc, on entre dans un cercle vicieux, une déstructuration du monde rural qui conduit à une aggravation de la déstructuration de la ville, n'est-ce pas, dans le monde rural, d'où la génération de conflits. Vous n'avez pas insisté sur les conséquences en termes de conflits et de guerres qui sont dues à ces changements climatiques et la ruée vers la domination des ressources, notamment les ressources en eau. Et donc, vous avez parlé d'énergie, etc., mais vous avez omis de parler de l'eau. L'eau qui est la source principale, bien sûr, d'alimentation pour les ménages, mais pour l'agriculture, pour tous les milieux, et les conflits portent. Ce n'est pas uniquement sur la colonisation des terres, de l'énergie, mais surtout la conséquence sur l'eau. Voilà, monsieur le professeur, ma question.
Aishik Silamin, I will answer in English just to keep this consistent. I completely agree with the comment that I omitted the next step in the analysis, which is this climate migration will inevitably lead to conflict. Why? Because we know historically when people move to urban areas because of climate change, the closest example we have is the Syrian conflict. Prior to the Syrian conflict, prior to the Arab Spring, Syria experienced its most intensive drought that moved 1.5 million people from rural areas to urban areas because they lost their livelihood. 85% of the livestock perished. Agricultural output declined massively. I don't have the numbers in front of me, but Syria used to be self-sufficient, one of the few countries in the region that was self-sufficient in basic food production, turned into a net importer during that time period. So I'm not saying that the climate impact and the drought is what caused the Arab Spring in Syria or the impact, but it did create additional pressure points, social pressure points, economic pressure points that made the political environment ripe for conflict. Because you have more people, more additional demand for housing, for jobs, for schools, for food, and that is not a good thing in any country. So the unfortunate reality is that the World Bank estimates of the millions of people that will be moving, the World Bank doesn't venture into the hypothesis that that will lead to conflict, but we know for sure that it will be the case, unfortunately. So my interest, and that's why I omitted this part of the analysis, because I wanted to provide some of the solutions. I wanted to focus my attention today on how can we prepare countries with the fiscal capacity to build the new infrastructure, to welcome millions of people in terms of housing and food and transportation and health. All of that means public investments. And today we know that governments don't have the capacity for public investment. My research is how do we create the fiscal space that allows us to build the resilient resources and infrastructure without causing inflation, without bankrupting countries. But I completely agree with you. Because of the limited time, I didn't want to go into yet another topic, but it's certainly 100% correct on your part to raise this issue. Thank you.
Thank you, Fadhel. Another question in the audience? Oui, monsieur. Alors, le micro, s'il te plaît, Céline. Vous pouvez passer le micro. Voilà.
Merci beaucoup. Merci pour le professeur Fadhel Kaboub pour vraiment cette conférence très claire qui a balayé tout donc, concernant le changement climatique. J'ai une petite question.
Professeur, pouvez-vous vous présenter, s'il vous plaît?
Mohamed Kouni, donc maître de conférence à la Gestion de Sousse.
Monsieur Mohamed Kouli, il est maître de conférence à l'AFSEC de Sousse en économie.
Donc, merci beaucoup. Donc, ma question est la suivante. Donc, l'Afrique subit beaucoup, notamment le nord africain, donc a subi beaucoup de conséquences de ces changements climatiques-là et probablement va payer donc un coût très élevé. Mais vraiment, le problème de changement climatique donc causé principalement par les grands pays industrialisés, par la Chine, les États-Unis d'Amérique, l'Europe, etc. Donc, probablement que notre système économique, le problème se trouve au niveau de ce système économique-là, qui manque beaucoup de solidarité à l'échelle internationale. Le rôle des organismes internationaux donc n'est pas vraiment un rôle suffisant pour l'aider à un problème qui risque l'existence humaine, non seulement au niveau économique, mais l'existence humaine, puisque notre globe est en risque actuellement. Nous vivons chaque jour donc, ces changements climatiques. Actuellement en Tunisie, donc nous sommes en novembre, il fait vraiment très chaud. C'est peut-être pour la première fois depuis des années et des années. Donc, je pense que nous avons besoin d'une solidarité encore plus grande entre les pays, et notamment de la part des pays les plus puissants économiquement. Ma deuxième question, c'est autour de la migration. La migration n'est pas à l'intérieur peut-être de pays seulement, mais la migration, ça va toucher tout le monde. Ça va toucher les pays d'accueil plus que les pays d'origine, puisqu'ils vont supporter un coût supplémentaire. Et c'est pour cela qu'il faut vraiment une réflexion donc globale sur cette question-là, le changement climatique, la migration et toutes les conséquences là. Donc le changement climatique fortement lié à l'emploi, aux inégalités, à la pauvreté, puisque les pays africains ne peuvent pas vraiment peut-être moderniser leurs industries, puisqu'ils vont toucher l'emploi, ils vont créer beaucoup de pauvreté, etc. Donc, c'est pourquoi peut-être donc il faut penser à l'échelle globale. Je vais voir donc votre avis, professeur Kaboub. Merci beaucoup.
Thank you. Very important observations and comments here. I'll add one comment that I didn't have time to put in the presentation, but I think it will clarify some of these issues. The world today, in my opinion, is being the global map, economic and strategic map is being redrawn into three major strategic blocks. One in North America, dominated by the US, one in Western Europe, dominated by the European Union in particular, and one in Asia, dominated by China with Russian affiliation and Central Asian countries. Where is the African continent on this map, on this global map? Where is the Arab region in this map? It's not a region that has its own strategic vision. In other words, all three major blocks, they already have a role for the African continent. The African continent for all three major blocks is going to continue to be the source for raw materials. It's going to continue to be the large market to absorb their production. And it's going to continue to be the place for low-cost assembly line manufacturing for foreign direct investment. So as I always say, for the African continent, if we don't have a strategic vision, long-term strategic vision for the African continent, we're going to be part of somebody else's strategic vision. And that is a wake-up call, hopefully, for all of us on the African continent, country by country, to realize that we're all in this together, and we need to build Pan-African solidarity, but not with empty words, with actual strategies and policies and implementations, so we can reposition the African continent once and for all as a key player on a global scale, because we control all the resources that are needed for the energy transition. And we need to leverage those resources on African terms for Pan-African benefits, not for neocolonial extraction. So there is no time to waste on this, because three things happen in the last 2 decades that are accelerating this the creation of this new global map. Number one, the 2008 financial crisis. Number two, the COVID pandemic. And number three, the Ukraine crisis that forced a lot of countries, including the US in particular, to rethink the globalization of the last 30 and 40 years, and to repatriate strategic investments and strategic industries on the American soil or nearby in the North American region. Europe is doing the same thing. If you notice what the European Union is saying, the European Union has been speaking specifically in terms of technological sovereignty, and same thing, repatriating supply chains, strategic supply chains to the European continent. So the opportunity is there, but it's not going to happen without actual strategies on a Pan-African level.
Thank you, Fadhel. We will take another last question because we are overtaken by time. The question is from our colleague Semi Besha from Sciences Economiques.
C'est bon, c'est moi. Merci beaucoup, Fadhel, pour cette présentation. Donc, je ne suis pas spécialiste du domaine, donc ma question va être très, très rapide. J'ai entendu parler cette semaine qu'il y a des banquiers qui ont lancé l'idée de créer un marché carbone local en Tunisie. Donc, est-ce que cette idée elle est intéressante pour la Tunisie, et est-ce que ça permet de résoudre certains problèmes que vous avez déjà évoqués, notamment en fiscalité, d'inflation, de souveraineté monétaire, etc. Et merci.
Very, very good question. The idea of carbon markets and carbon trading and carbon taxes, all of these would have been useful solutions or parts of solutions if we started this 30, 40 years ago. But the reality is that these are not transformative solutions. They're very good solutions for people who want to trade a particular product, a new product in this case, carbon credits and so on. So it is a good market for the participants in the market, but it's not going to end, it's not going to really accelerate the decarbonization of the Tunisian economy or the global economy, unfortunately. That's the short answer. I'm happy to provide resources and critical perspectives on this, but I'm not surprised that these ideas are proposed in Tunis these days.
Thank you so much, Fadhel. We are very, very glad that you have been with us today. And now I think you must have a rest.
Thank you. Thank you for the kind invitation. And I wish I was able to join you in person, but hopefully next time for Beta 23, I'll join you in person, inshallah.
Yes, we hope so.
Inshallah. Thank you.
Thank you.
Bye.